Welcome to Subramani. Picking growth stocks is not very easy, right? So, picking growth stocks which do well over long periods of time is not going to be very easy. And so, I got to Goldman Sachs Rule of 10. I do not know how many of you have heard about this. There is Goldman Sachs has something called a Rule of 10 or Rule of 10 for finding the next top growth stocks. I mean, it need not be multi-baggers, but yeah, top growth stocks with the highest potential. So how does Goldman Sachs do that? Goldman Sachs created something called Rule of 10. To pass the test, company must generate annual sales growth of 10% and capable of continuing to do so in the future. It's not going to be very easy, and for India you may have to make it say 15%, right? Like some portfolio managers do. It should grow at 15% in India. It should be in the index, so it has to be an index stock in India. Let us say it should be in the Nifty or in the BSC 30, right? In 2025 there were 21 S&P stocks which could meet Goldman's revenue criteria or revenue target. Investment decisions should of course not be based on that alone. So Rule of 10 says that the stocks with the most potential to outperform the S&P 500 was to analyze today's biggest winners, so-called. So you had your Magnificent Seven, but will Magnificent Seven continue to be great? I do not know. Then there is Sahil Kapoor of DSP, who says if you invest in the top 10 stocks, right, and constantly monitoring that, which is the top 10, that will outperform even the index, because he's saying the biggest companies can survive the toughest recession. So they will. So typically Sahil Kapoor is also saying the growth rate is not important as long as the direction is good. So during bad times when others are failing, these companies are likely to do very well. So your companies which like Amazon, Apple, Meta Platforms, Microsoft, all of them were in the top 10 or maybe Magnificent Sevens. Of course they all did well. The Rule of 10 works like this. First of all, you should be in the index. So in India, the 30 or the 50, or maybe I think 50 is a better bet. They should have grown their revenues at least by 10% in the last 2 years. For Indian conditions, you may make it 3 years. You may make it 12%. Be expected to grow by at least 10% in the present year, in the next fiscal year, and the fiscal year after that. That's again little difficult to guess, but you have to talk to the analyst. The company may not reveal much, but the analyst may know how will this company achieve 10-12% kind of a growth. 12% because it gives you some cushion. If instead of 12 it is 11, you're still okay, because you basically have a 10% criteria. So when you look at companies at 12%, no, of course when you run the screen and you get companies which are grown at 20% and you think they have potential to grow at 15% next 2 3 years, they will obviously score over the 10% criteria. But if you have not grown at 10%, you just don't make it to the cut, right? So 2024, 25, 26, 27, 27, 28, you have to, 24 is already gone. So 25, 26, 27 and 28 you should be able to guess. So I'm sure you can find enough screeners which will tell you which are the lists. Of course there you have your Airbnb, etc., making it to the list, Cadence, Autodesk Design, etc., making it to the list. In India, if you can run the screen, no, I'm not going to, it does not change anything for me. I was seeing the top 10 and I realized I owned 8 or 9 of them. One company which is there, which I could have owned, but I don't like the management, is something which is there in the top 10. So it will not be there in my portfolio ever, and of course I'm not naming them. Can investors find this rule of 10 stocks? Yes, it's possible, because all you need is a screener where you can go and say, have they grown at 12% in the last 2 years? Will they grow at 12% in the next 2 years? Is more difficult. That is a judgmental call you have to take. But you can put some other criteria saying ROCE should be so much, RONW should be so much, right? I want companies based only in South, only invest in South. I don't want it if it is based in East. Some of those criteria you can put and arrive at your own screen, right? So the bottom line is very simple. Rule of 10 aims to identify the next wave of the best stocks already there in the index, remember that, and capable of delivering the most capital appreciation by focusing on past and future revenues. Some kind of guesswork, some kind of research goes into this, and I'm sure if you use some of these things and you continue to do an SIP in those stocks, though personally I prefer doing a SIP in a top 10 portfolio rather than doing SIP in individual stocks, I think you should be home as a good investor. If you take a 10-15 year view, I think you should make good money. Thank you.